Hello? Yeah, perfect. So it was already changing. My personal opinion is that it accelerated dramatically, and it has brought about new challenges for the players. And specifically, what we need to look at is, and I'll get to the conclusion later on, is we need to revalue the value chain of what we buy, what we pay for, and better understand where we want to put our money. Now, SMB crisis generated new costs, new risks, and new problem with access. On the cost side, credit, clearly an issue. We have seen that getting credit lines, getting access to the balance sheet of big banks has dramatically changed. Same for liquidity. Lots of the big market makers are reevaluating, the value chain within their own business, and see that more and more of the business they do on the flow side is unprofitable, and they tend more and more to weed out clients that do not generate value. If you step back a few years, the big business of the banks has always been the large tickets from the hedge funds. More and more, the business has morphed into smaller tickets, $1 million or so, and more on the 3-4 currencies where they cannot extract value, and it costs them more to process the trade than actually what the spread is. So they were willing to do this one in the past for people that then eventually show them also the big tickets. The problem is that the industry has evolved, whereby lots of the players that trade with them only have this type of trades, and therefore they become highly unprofitable. On the risk side, we're facing more costs on the front end in managing pre-trade risk checks and bringing in technology that allows us to stay in business in another SMB. We have seen a few of the players basically go out of business simply because post-trade checks were not sufficient to manage their risk. And again, appetite in general for extending credit lines to anybody has been waning, basically. Access to PBs. The latest one is some of the PBs have increased their minimum capital requirement or assets under management. The initial things after the SMB was 25 million. Now we're talking about 100 million, and that is going to probably level out for everybody around that level. So, lots of people cannot even entertain a conversation with the prime brokers. And again, if they do, they need to put up capital, which can become very expensive, especially in the brokerage business where you may not need that capital, to run your business. So this is what I just described. Basically, first thing, we need to look at risk management. We need to look at pre-trade solution, whether we build them in-house, whether we buy them outside. There is lots of players out there that provide these solutions. We have ourselves look at a couple of a combination of in-house and external in order to make sure that when we extend credit to people, we can manage trade by trade and drill down to everything, every level, from the counterparty to the actual concentration by currency pairs, and so on and so forth, and provide limits at every level of the risk chain. Now, when you look at the credit side, the difficulty comes on, are you big enough to go and speak to a PB? And if you're not big enough to speak to a PB, are you valuable enough to have a bilateral relationship with a liquidity provider or with more liquidity providers? Will they engage with you on an ISDA basis for the amount of flow that you can show them? So basically, you are already weeding out lots of opportunities by either being not relevant or too small for a PB. The next thing is to consider is what type of business you do. If the traditional brokerage model of, for example, giving up trades and trying to built into the space that the banks were leaving open is now, if it is dependent on the prime brokers you are using or the prime of prime you are using, the business model is not sustainable because more and more the regulatory aspects, blacklisting, jurisdictions, etc., and sanction on different countries are closing doors to the type of business that anybody can do via prime broker. So that's my last point. Agency business is quickly disappearing, and we need to look at alternatives to provide value to customers. Now, in our view at ADS, principal trading is the solution to most of these problems. What we have been doing, we have been putting our capital behind our clients and offer clients the ability to trade with us using our liquidity and using credit lines we made available to them. So the idea is, instead of being an intermediary and putting together two people and then let our prime broker settle those trades, what we want to do is to offer clients the ability to engage with us on a principal basis, open an account with us, hold a position with us, and in this way, where we add value is by extending the total credit they have in the market. The example I like to use here is, post SMB, people may have need for $1 billion in lines daily, but post SMB, they have been cut down to $500 million. If we all try to use that $500 million to the PB system, there is zero value added for the user. We're just competing on price. However, if we, as ADS, go back and say, you know what, you need $1 billion, you have $500 million, I cannot fill the whole $500 million myself, but I'm happy to give you $200 million on top of what you have. All of a sudden, we have increased by 40% their capacity. And the only thing we are asking them is not to ask us to deliver that physical position anywhere because that will be too expensive. So the idea is, we give you lines, trade with us, hold the position with us, roll the positions with us, and you benefit from that. Not only this increases their credit capacity, not only gives them additional liquidity, but it saves them lots of money on PB or settlement fees because we are not giving up the trades to their PB. They are not paying for these trades with their PB, and the saving can be considerable, especially as PB fees go up and will continue to go up. Another point is that on our risk management side, not because we are more aggressive in terms of giving free credit to people, but because we have less constraints than banks do, we can be more competitive on the margin terms and therefore ask our clients to put less capital against the trades that they do with us. Now, on top of the principal trading, we have been developing what the industry calls prime of prime. So basically what we do, on the same principal trading account that we would open for clients, we would allow clients to see liquidity directly, their own liquidity from different liquidity providers, capture those trades in our system, and settle them against the overall liquidity, providing netting facilities in our own account. Again, here I think we can be not only adding value by creating additional credit facilities for the client and saving PB fees, but also by providing a full round service and access to pretty much all the liquidity provider ADS has access to. So we're talking about, about 3 dozens of people between single banks, non-banks market makers, and the various ECNs. So what we have seen is that the role of the traditional liquidity providers and the prime brokers have been diminishing. Their investment in the industry is diminishing. It will continue to do so. Secondary market liquidities, it started off with HFTs, but more and more different players are involved. In our case, for example, because of our geographical positioning, we have access to liquidity from totally different sources than anybody else, coming from the Gulf region and players, in the region we are based in. And of course, prime of prime is going to grow. However, prime of prime may not be the long-term solution. The problem with prime of prime is that it still relies on a prime broker at the end of the chain. And those people are becoming very much scarce resources. So we need to start thinking ahead now and understand how the prime brokerage market the FX market may work, continue to work, and continue to be a 5 trillion, business without prime brokers. We're down to 5 or 6 that are really, providing the most of the credit. And I'm not sure by the end of next year we still have 6. In a panel, actually in the main room, when they talked about multi-asset classes a couple of hours ago, 2 of the biggest brokers in the world, global brokers, both stated that they see the number going down to 0 in the next 2 to 3 years. Maybe aggressive, but not far from the truth. The problem is, the less we have, the more difficult it will be to be an account holder with them. So, even if another 1 or 2 drop out, having 4 makes it harder for everybody nonetheless. So I think we need to start thinking about what we could do to settle trades when we are not a direct member ourselves of settlement systems. We are not market makers and participants to the interbank market or participants into CLS. And one of the things I personally want to monitor closely is blockchain and how eventually any development in that field may help us bypass the need for a prime broker. Now, conclusions before, I'm very happy to take questions. Okay, the industry has changed, nothing new here, fine. It has been changing since, the heydays of it. The question today is more about how we all respond. We need to be actors in this change because it affects our bottom line big time. The actual profitability of FX is greatly diminished. We all know we are all, fighting for smaller and smaller margins. We need to be very careful what we pay for, as I mentioned at the beginning. I see that as user of FX, we use pretty much 4 suppliers: liquidity, credit, connectivity, and I'm missing out one. Oh yeah, and risk management. Now, we need to be careful, and this may sound controversial, but we need to try and pay more for people that we cannot do without. So I've used at a recent event this sentence saying, if a prime broker comes to me and say, I want to charge you $5 per million, in the last 15 years, our conversation has always been, I can't afford that. I can only pay 2.5, and try to haggle for pricing until you find a solution. Today, we should go back and say, sorry, $5 per million doesn't work. I want to pay 8. Right? Sounds absurd, but why am I saying this? Because we need to become more and more relevant and valuable to the prime broker. They are the only people in the chain that we cannot replace. Today, we can become market makers. Maybe complicated, but we can do it. We may get rid of everybody on the technology side. We can hire teams and replicate it. It's expensive, yes, but we can do it in-house. Same for risk management. We can get the technology and do it, but we cannot get credit on our own unless we put billions of dollars in capital in the company. So having a prime broker behind you that values your business, that thinks twice before they shut down your lines, is the most important thing for us in FX to stay in business. So the days of haggling for price with the prime broker, but then agreeing to pay our technology aggregation connectivity provider $10 per millions are gone. The value chain has reversed dramatically. I think personally the value differential is 1 to 100. So if you want to pay $10 to anybody providing you the aggregation software, you need to pay 1,000 to the prime broker per million. That is not possible. So if you're paying 5 to the prime broker, you need to pay 10 cents to the guys who provide you electricity. Otherwise, we are all out of business. Again, what will change is that more people will move away from multiple liquidity providers. And I'm looking at the case, for example, of a domestic regional retail broker. Does it make sense for them to have their own 10 liquidity provider, a prime broker that charges them minimum fee, and even if they aggregate through NetLink, they never get to minimum amounts that actually make it sense. They always suffer for minimum ticket fees. The prime broker are unhappy because it costs them too much money to process their business. They kick them out. They go to a prime of prime. Prime of prime tells them $20 per million, and they go like, I can't do that. So the solution for these people is really to go to a broker, a big broker, like ADS, for example, and take our liquidity. And take the liquidity, which is already pretty much an approximation of best execution by definition, coming from many liquidity provider. They don't have any cost on the PB side. They have a service that they mark up, white label, whatever. If they have their technology, they use ours, etc. But we need to become a little bit less pretentious and smarter in the way we deliver our business. Thank you. Questions? I'll be happy to take them. My background, by the way, has been pretty much 20 years of prime brokerage, and I just moved on the other side of the fence to ADS about 4 months ago. So I can take lots of questions if you wish on the technical side on prime brokerage.
Are you guys being first out and offering 8? Can you? I don't know if we need it. Oh, okay. Are you guys jumping out and offering 8 instead of 5 voluntarily to get the ball rolling here?
Well, in fact, yes and no. What happened is our business is growing, and we are adding prime brokers. And our business has been growing. People know us from the FX brokerage side, but in fact, we are a much more diverse organization, especially in the Gulf region. And we have a very large and growing global markets type of activity, which both is equity and fixed income capital markets. So we engage a lot with the big banks, bringing them lots of valuable business outside of the pure brokerage side. So we benefit from large relationship with these people, and we keep on growing our FX. Therefore, we need more PBs and more PB lines. So recently, we have been negotiating with another PB, and their offer to us was slightly cheaper than our main PB. I told my main PB, I said, this is what I see in the market. And they asked me, do you want me to reprice? And I told them no. To me, saving 25 cents was not valuable enough as having these people know that I don't want to be repriced and I want them to make enough money. Of course, if their price was to be at a level where I cannot be in business, of course, yes. But the way to negotiate for me is different. I want to go to them and avoid them increasing my price in a year's time. I want to be valuable enough that they want to do more business with me at the current price, which I can afford. And the way we do that is by bringing more business to our core relationships. So, for example, we launch a CFD business. Whom do I want to hedge my CFDs? I go to my prime broker and say, are you interested in the additional piece of business? We had to do some futures clearing, for example. Rather than going for the cheapest in the market, we go to our PB and say, hey, more business for you. Because the key success factor for me going forward is my PB must think not twice, but 10 times before shutting me down or before touching my margin limits when an SMB happens, right? Because I'm too big for them to just say, you know what, $1 million of revenue, who cares? Shut it down.
So just curious, what do you see as the worst possible scenario here? We all start having to offset to futures contracts?
No, I mean, it's the worst scenario is that the PBs pull out because, at the end of the day, the cost of capital of doing this business for them relative to how they've been squeezed by the policy of many different players becomes something they cannot afford to do anymore, right? And therefore, we were talking at a conference, and I've asked the question, ask you the question, $5 trillion a day, how much depends on PBs? I.e., if today we shut down to zero the lines on prime brokerage, how much of that $5 trillion doesn't trade? Some people said 80%, I think exaggerated. Some other 20, I think is too little. But even if it were 20%, it's $1 trillion a day of liquidity gone. If it is bigger than that, the number is even worse, right? So, we need to find a way to keep these people interested in the business. And otherwise, it gets all exchange traded. And the problem with exchange trading is, everything gets very much, standardized. You have less flexibility. But the worst thing with exchange is that they are not risk takers, right? All of us are in business to take risk, like from the banks to us as brokers or intermediaries or any hedge funds, etc. The problem is when you go to an exchange, the margin level becomes crazy, right? And the cost of clearing becomes crazy as well. You may say, okay, that one, no matter what, I was paying PB fees, I pay clearing. But normally, the margin rates becomes insane.
Anyone else?
Behind you.
Hi, thanks. You were talking about the ability to survive an SMB type event. If we had one tomorrow, does it play out differently? Or is this just going to be the straw that breaks the camel's back for a lot of people?
Well, I think if the same thing happens tomorrow, yes, we will have a different outcome because, everybody now is paying attention to the pegged currencies, and, there is a little bit more thoughts around what can happen there. The problem is that it's never the same thing happening again that takes you down. Is whatever you didn't pay attention to that eventually happens and catches somebody unprepared. The thing with the SMB, which is interesting to me, is retail brokers, B-book, non-B-book, right? And when you were a credit officer at a prime broker bank, from JP Morgan to BNP, whatever, and ADS came to them and say, hey, I want you to be my PB, let me present my business plan. I do institutional, I do retail. They ask you, retail, B-book or A-book? If you say B-book, immediately these people will freak out, right? Because they would think, oh, these people, who are they? Do they have trading expertise? Can they handle risk, et cetera, et cetera, et cetera? Do they have enough capital? In fact, the people that survived the SMB pretty much untouched are the people that had a B-book. Because everybody who had run a full offset of the risk got closed out at massive gaps, et cetera, and created all the problems that eventually they suffered or shut down their business on. So, in that particular case, the things that was considered riskier played in favor of the risk taker. So yeah, it's very difficult to say what will be the next crisis, right? But we need to be prepared. We need to be more vigilant. We need to close the gaps. To me, pre-trade risk checking is fundamental. It's not fundamental for the banks. All the prime brokers do post-trade, right? They don't care. Why? Because they're dealing with massive margin from us. So, if they let us go one trade above the limit, big deal. But when you trade with smaller people that cannot afford, massive losses or losses that are significant in the millions of dollars, you need to pre-trade pre-trade check. And nobody was ready for that. Very few people did it. And you know, we have stories of people that maybe lost money, etc. But whether they lost money or not, they realized that they couldn't continue like that and decided to exit the business, whether they were doing prime of prime before, they don't no longer do it, or they had to invest in the technology and do things differently. You have one? No? No question? Well, thank you so much.
Thank you.